Why would you borrow from yourself? Well, if you did have 50,000 in your life insurance policy banked away and you wanted to buy a car, you could borrow out as much as you wanted to pay off that car. Let's say it cost 50,000. So you borrowed 50,000. You don't have to pay back that loan. If you borrowed from the bank, you'd have to make regular payments or it would be repossessed. So, you have some kind of blip in your income. It's like, and you were paying back your loan because you wanted to make sure that money was available for you in the future because you borrowed it out. Maybe, your kid was only 12 and there's some money in there for his college education. You borrowed it out to buy a car or something and you're going to just pay it back that way. Yeah, you have a blip in your income. You don't have to pay. You don't have to make a payment. The payment's up to you whether you pay back the loan or not.
And that's one of the questions that we just had over here. Even loans that you make, you have to pay back. Now, he is true. The loans have to be paid back. But two options do you have as far as paying that loan back?
Death benefit.
So you, number one, have the death benefit, meaning you can wait until you die and all the loans are just simply just going to come from your death benefit. Meaning, say if someone had a $500,000 death benefit and they used during their lifetime $200,000 of the cash value that they grew in their policy, $200,000 is owed plus interest to the company. So when they pass away, the first money that is going to be paid from that death benefit is going to be money back to the company plus interest. So let's say if it was $250,000 in total, including the principal plus interest, the remaining $250,000 would go to beneficiaries. Or
I'm still
no,
on.
no.
Go
So
ahead.
I was just saying that there's two options. You can either let the death benefit pay your loans back, or you can pay your loan back yourself while you're living, and it's simply just going to add more equity to your account that you can redo the buy, borrow, repeat method, meaning you can put more money back into your policy and leverage that money back out, buy other assets, utilize it for vacations, paying off debt, whatever you want to do. The money's yours. There's no strict repayments or anything like that. You have access to the capital that's in there. And from there, it's just going to continue to grow. Whether you use the money or not, it's truly up to you.
Yeah, and the example I gave earlier of the young 30-year-old putting in 42,000 and in retirement getting 500,000 a year. By the way, even though taking $5,000 a year in tax-free loans, the death benefit is exceeding $2 million net of loans, net of the loan. So there's still a death benefit even with loans in place to be paid off.
Exactly. You just continue to build an asset. Some see it as bad debt. I could see the point of that, to where you're holding, let's say, a loan balance plus the interest. Or you can look at it as you have an asset that's going to out earn not only the loan, not only the cost of insurance, but also have growth in your money, but also a death benefit if anything was to happen to you, because it's not if you die, but when you die. This is just one way to utilize your funds to build up an asset while utilizing them. Not many other places can do the same, and that's what we're here to educate on.